Good evening. My name is Amy Bach. I'm the Executive Director of United Policyholders, and I am so pleased to be able to present tonight's program, which will feature some very knowledgeable experts on topics that you may very well need to know at this time in your lives. I'm so glad that you were able to make the time to be here with us, and we really appreciate your attention. I'm going to be starting the slide deck now. Okay. So tonight we are talking about post-wildfire rebuild financing. And as I said, while I'm glad you were able to make the time to be with us tonight, I'm so sorry for the circumstances that makes it necessary for you to tune into a program like this. However, the good news for you is that our organization has many, many years under our belt, 30 years, in fact, of listening to people whose homes have been damaged or destroyed in wildfires, and getting answers to your questions, finding experts that know what they're talking about and will give you information in bite-sized pieces, in using as clear language as possible. We know that it was never anyone's intention to become an expert in insurance or rebuilding, but here you are. Okay, hang on, I've got a little, there we go. Okay. So by now, you probably know about UP, that we are a 501c3 nonprofit. We don't sell anything. Our information is free of charge. We are a consumer advocacy organization. We know a lot about insurance. We know a lot about disaster recovery. And we have a lot of great friends all across the country, including departments of insurance and professionals, some of the lenders you're going to be hearing from tonight, who share our commitment to giving you useful, accurate, reliable information without strings attached, without sales pitches. A lot of the way that our team up, as we call ourselves, gets our work done is through teamwork. So we have our own professional staff, and you'll meet a couple of them tonight, myself is included, and then our government, business, and nonprofit partners, our volunteers, and those are the people that make up our team and that help us bring you programming like this one and some of the other programs that you may already have listened to or participated in. Tonight's program is through our Roadmap to Recovery, which focuses on helping you get back home after a catastrophic loss. Hopefully you know that we have curated libraries on our website for people in California and Colorado, and you can find those here, and we do our best to keep them up to date. Coming up next week, we've got another one of our Survivor to Survivor forums where you can hang out with other people who are in your similar situation and share ideas and challenges. And then on the 11th, we will do another one of these educational webinars, and we'll be talking about resilient rebuilding, meaning what are the innovative techniques that people are now using to build a house that's less likely to burn in a future event, as well as possibly be more green, more sustainable, etc. So that'll be on the 11th. And then we'll have another Survivor Forum on the 17th. So that's coming up in May. And of course, we wouldn't be here without those who donate and help fund our organization. And we're grateful to all of them. A reminder that we're here tonight to give you just general guidance, not legal advice. And our speakers are volunteering their time as educators. So tonight, I'm very happy to be joined by two people from my staff, Valerie Brown and Annie Barber. And Annie is very special to us because she herself went through losing her home in a wildfire, and she's going to share a little bit about that in a minute. Very happy to be joined by Sidra Goldwater, who's with Fannie Mae. She will explain when it's her time to speak a little bit about what Fannie Mae does and why she's here. I'm also pleased to be joined by Sean Charter with the Redwood Credit Union in California. Very, very community-minded credit union in the Santa Rosa, based in the Santa Rosa area, but with branches around California. And very much like our other special guests with Elevations Credit Union in Colorado, Redwood Credit Union has gotten a lot of experience with having their members of their credit union and their borrowers lose homes in wildfires, and then be in a position to help them with information and support of many kinds. And we're also joined by Elizabeth Millian with Elevations Credit Union in Colorado, and her colleague Todd Payock, also with Elevations. Thank you so much to my panel for being here tonight. We're going to be covering these 4 topics: mortgage-related decision-making, loan options for financing the rebuild of an underinsured home, paying for construction with insurance funds, escrow account best practices, and then we're going to talk about the flow of money to your builder and how that works, which in fancy talk is fund control. And then we talk about construction quality control, which is kind of interrelated with having an escrow account and having there be private progress payments. So this is just a reminder. I don't know whether I really can't describe this as funny, but we do try to keep things a little light from as best we can, because none of this feels light. But just a reminder that many people have been on the road that you're on and found their way to the other side. And one of them is Annie Barber. So Annie, if you want to take us through these photos, and thank you so much.
Thank you. So we're just going to show you the pictures of my rebuild. Hopefully it'll give you the hope that it gave all of us and myself as I watched the progress. So this is the very front side of the rebuild, where they were just, digging trenches for the foundation and plumbing. And then we move on to the actual foundation, which was a very joyful day. I just rode my bike over there and I was like, oh my gosh, I'm getting a foundation. Then we moved on to the framing. And then some final touches to make it actually look like a house, the one that I actually picked.
So Annie, you lost your home in an area that seems, Coffee Park in Santa Rosa, seems like there's some commonalities between that area and some of the areas that burned in the Marshall Fire. Was that your impression when you went out there to Boulder?
Yeah. I think I talked to a survivor who said that you normally would have some high winds, but it would come with a blizzard as opposed to a drought. Our fire came through a subdivision that really should not have burnt, and it came through at a very high rate of speed, and it traveled very quickly. And our houses were probably a little closer together than Colorado, but not by too much.
And your community, very much like Superior and Marshall, pulled together big time.
We were one of the first ones in 2017, the Tubbs Fire, and one of our supervisors introduced us to the block captain program. And so we ran with that, and that was really advantageous for our neighbors.
To sort of share best practices, try to help each other out. And I know you've been running a lot of you've been sort of facilitating a lot of our survivor to survivor forums. So first I want to say again, thank you, but also just to let the audience know that Annie has really, I think, a lot of understanding of now where, not just from her own personal experience, but also because she went out and covered our table at the local assistance center after the Marshall Fire, and she is now helping people throughout California and the Dixie Fire, Caldor, etc. So some of what you'll be hearing tonight and what you've already heard is comes in part from input from Annie. And there it is. There's the butte that you live in today.
Yes, yes. So happy when it was completed. So excited. As you can see, there's an empty lot next to me, actually on both sides. I was
Still?
Pardon? No.
Still now? No. Okay.
We are 4.5 years out, and we are about 98% back, with about 10% of those still in the building process.
Okay. All right, so because we're going to be throwing some technical terminology at you, but also because, hey, it's, you know, the end of a day, and I always think it's a good idea. We take a little minute here to kind of relax our shoulders and, you know, try to let the oxygen flow to the brain so we can process some of what's coming your way. So a little bit of lingo to take you through and just sort of digest what the experts will be sharing. An escrow account is basically a savings account managed by your mortgage servicer. Fannie Mae is a government enterprise created by Congress to promote home ownership. They buy mortgages and home loans from lenders. Sidra will explain how they fit in. The mortgagor is your lender, bank or credit union that loaned you money to buy the house that you lost, or to buy, or to do what you want to do going forward. And then you are the mortgagee as the borrower. And then there's the servicer, which is something that most people don't really know what that means unless they're in the business. That's the company that sends you mortgage statements and handles the day-to-day tasks for managing your loan. So now that you know everything, we're going to get into mortgage-related decision-making, and I'm going to turn it over to my friend Sidra Goldwater with Fannie Mae to share her slides. Are you ready, Sidra?
I am. Hold on, I will share my screen.
Okay.
And so as Amy was saying, I work for Fannie Mae, and probably most people have no idea who Fannie Mae is, or our, as we like to say, our sister or brother company across the river in Virginia, Freddie Mac. And so basically, we are the two largest purchasers of mortgages in the country. So basically, Fannie Mae owns about 1 in every 4 single-family loans and about 25% of the rental units or multifamily mortgages in the country. Most lenders, banks don't generally hold on to their loans. They generally sell them because they want to be able to make additional loans, and we buy them and we package them as something called a mortgage-backed security, which gets passed on to investors like insurance companies, retirement, things, but basically long-term investors. Now, the whole reason I'm going into this is why who owns your mortgage matters, is because who owns your mortgage sort of sets the rules for what can happen to your mortgage over the life of it. And particularly when you start, have experience, a natural disaster or a loss event, it can impact what your servicer will offer to you. And so the policies I'm going to be talking about today are the policies for Fannie Mae and Freddie Mac. As I said, it's about 50% of the market. Most servicers tend to follow our policies, not all, but most do, because we own, as most of the loans. So we have about 1,300 servicer partners out there. So pretty broad swath of the lending landscape. And they want to just sort of follow one set of procedures. So the first item I'm going to talk about today is a forbearance. And, Amy has talked a little bit about, having, you know, a plan, understanding your options and all that kind of stuff. And that's one of the things that we feel very strongly about here at Fannie Mae is before you make any decisions in terms of, you know, paying off your loan, rebuilding, whatever, just sort of, you know, take a breath and, you know, as we just did, and figure out what you want to do. And this is what a forbearance allows you to do. So a forbearance basically provides a period of time where the homeowner does not need to make any payments. You still have to, you know, eventually pay all those mortgage payments back, but it gives you a chance to sort of breathe and figure out what you want to do next. And so you don't have to worry about, you know, foreclosure. You will not be getting any of those notices. You can either pay part of your mortgage if you can afford to, or no payment whatsoever. You will not accrue late charges. And if you have a Fannie or Freddie loan, you do not need to provide any documentation. All you need to do is basically pick up the phone and call your servicer, the person who's on your mortgage and statement, and say, I've encountered, you know, a hardship. This is my circumstances, and they will work with you. So generally how a forbearance works, again, if you have a Fannie or Freddie loan, is the initial forbearance term can be up to 6 months. Now, most servicers like to offer shorter forbearances, let's say in 3-month increments, and that's perfectly fine. And the reason that servicers want to do that is they want to make sure that they have contact with you, because they want to make sure that they keep that amount of delinquency, the amount of missed payments, as minimal as possible. So, you know, by having, you know, a touch point every few months, that really makes sure that they understand what's happening, and that, you know, if it, you know, it only takes you 9 months to get back into your home instead of, say, 6 or 12 months, you have reduced the number of missed payments. You can always shorten a forbearance plan at any time. And one of the key things that will happen is your servicer will send you the terms of the forbearance plan. And so it'll say there'll be a no payment, or if you want to make your escrow payments, that would be for like taxes and insurance, you can go ahead and continue with those. So as I said, this is not a long-term solution. This is just temporary, and it allows you to skip those payments without consequences. You can extend that initial forbearance for another 6 months, so for a total of 12 months. And once you think you can go back to making your payments, you should reach out to your servicer and let them know so that they can figure out what is the next step for you. And I know there's a lot of scary information on this slide, but I'll be going into it in the next few slides in more detail. But these are sort of the exit options after a forbearance plan. And so they go from sort of, I would say, least impactful to most impactful. And there are a lot of terms on here you may or may not have ever heard before. And so I'm going to walk through these options here right now. So the, you know, workout offering that you're probably most familiar with is a repayment plan. And what a repayment plan is just probably, we've all done this, you know, like a credit card or whatever. It's basically you make a payment plus. And so this is something that usually works if you only miss 1 or 2 payments. It doesn't usually work for situations where you've been on a forbearance for a longer period of time. Again, you know, your hardship has been resolved, you're back in your home, you can make that payment plus a little bit more for a specific period of time. What's more likely, and this is a new offering that we came out with in 2020, is our disaster payment deferral. And what this allows you to do is basically take those missed payments, so up to 12 months, and that includes any taxes and insurance advances that have been made, and basically put those in a non-interest bearing balloon that's due when you pay off. And so when that could be 20 years down the road when you finally pay off your mortgage, it could be when you go to sell the property, it could be when you refinance. So that's when you would have to pay off those past those forbearance months of forbearance. one of the key things is that the term of your loan will not change. So if you are, say, 25 years into a 30-year mortgage, you will still have 25 years into your 30-year mortgage. You will also keep your interest rate. So if you were lucky and got in at like a 2.5% interest rate, you will keep that 2.5% interest rate. And that obviously, with interest rates going up right now, I know right now they're about, a new mortgage is about 5%. That is a huge savings and has obviously major impacts to you. The last thing, again, is you will get a written agreement as part of this. So it'll tell you how many missed payments, what that non-interest bearing amount is. All those details will be in that written agreement sent to you. Now, who will qualify for payment deferral? So basically, it's pretty simple. You have to have been current or less than 2 months delinquent when your disaster occurred. You need to be at least 1 month delinquent, but no more than 12 months delinquent when you're evaluated. So when you exit that forbearance or when you talk to your servicer. And you can't have received a previous payment deferral for the same event. So if, God forbid, you hadn't received a payment deferral, and a lot of people did this for COVID, you would still qualify for a disaster payment deferral because we consider those two separate hardships. The next workout offering I'm going to talk about is a modification, and it's our flex modification. So this is our standard mod offering. And so a mod is a little bit different than that payment deferral I talked about. With the mod, you're actually changing the terms of your loan. And so how this works, and really what we're trying to do with that, is if you can't go back to making your previous mortgage payment, say, your insurance didn't cover the complete repairs, and so you can't go back because you may have taken out a second loan to help pay for those additional expenses, or went out of pocket, whatever the circumstances may be. A modification, basically, what we're trying to do is target that 20% payment reduction. How we do that is by extending the term to 480 months or 40 years. And that's a scary number. I will be the first one to admit that that's a scary number. But one of the things you need to be clear about is that you can still pay that loan off early. It doesn't force you to, go to the full term. You can refinance. All those things are still true. All it's doing is extending your term. You may also be able to get an interest rate break. It's a little bit less likely now that interest rates are higher because we look at what is the current interest rate today and compare it to yours. So if you had a lower interest rate, you would keep that. But that's basically how that works. In terms of who is qualified, basically almost anyone would be eligible for this. The one caveat that I would let folks know is if you were less than 3 months delinquent when you're entering into the modification, you will need to provide your servicer what we call a borrower response package, or basically documentation explaining your hardship. It's not very detailed, it's just a few pages, but we would need an explanation of your hardship.
So
now
I'm sorry, Sidra, sorry to interrupt. Just so, in case people are worrying, this information is captured also in the Know Your Options document that we posted a link to, yes?
Yes. So
Okay.
Know Your Options, just to give a brief explanation, and I'll go into this in a little bit, is our our borrower-facing website. And so we go into all these different workouts, what a forbearance is, et cetera. And it is in probably a little bit more plain English than the one I'm going into today. Our comms folks, our communications folks, are much better at marketing and explaining things. And so all that information is out there. So correct. Thanks, Amy.
Great. I just didn't want people to feel like they'd had to.
No, I'm going through a lot of information.
That's okay. That's okay. So. Keep going. This is great. Thank you.
Sure. And so this may be a term that folks are familiar with or not familiar with a short sale. And basically what a short sale allows somebody to do is basically sell a home for less than they may owe. This is very unlikely these days. Housing prices have skyrocketed. And so this is something where it may happen where like you just want, you've decided that you don't want to rebuild, etc. This is basically allowing you to walk away without going to foreclosure. You may have to make a financial contribution, but you will receive a deficiency waiver, which means that it'll be reflected that you have paid off and you're not responsible for the remaining balance of the loan. Similar to a short sale is if you couldn't sell your property, you could do what is called a mortgage release or a deed in lieu of foreclosure. And this is basically where you transfer, you give the property to your servicer, and in exchange, you receive that deficiency waiver, and the loan is paid off for that. So those are very unlikely options, but I did want to at least, because those were on that slide, walk you through those. Now, Amy had talked about our Know Your Options website. I also wanted to share another resource that we have created, which is our disaster response network. This was something that Fannie Mae came out with after Hurricanes Harvey, Irma, and Maria. And one of the things that we realized is that although there are a lot of wonderful housing counselors out there, most of them aren't familiar with the whole recovery process after a hurricane or a wildfire. And so we have partnered with a nonprofit who does have housing counselors who are HUD approved. They're very familiar, they're experts in how to apply for FEMA, how to apply, work with your insurance, SBA, claims and loans. They're happy to hop on a tri-party call with you and your servicer or your insurance agent and explain. And so, it's another tool out there, particularly when you may be looking for sort of a trusted third party, because there's a lot of information that you're getting thrown at you and you may not understand it all. Just, somebody to reach out to. I believe Amy has probably shared these. We have flyers. I believe she shared those in the past, but I at least wanted to get this phone number out there if you hadn't seen it before. And so it's 877-833-1746. And one of the key things to be aware of is that this is a no-cost service. So basically, it is free. You basically will receive up to 18 months of counseling. And so it is just a great resource to be aware of. And then, as Amy had talked about, is your Know Your Option, or our Know Your Options website. And this, as I previously said, is our sort of homeowner and renter. So if you also are a renter, there's information out there as well. But basically explaining a lot of all this information that I just covered today. And with that, I will stop sharing.
Thank you so much, Sidra. And I have a very basic question for you. And that is, and just in case you have to, I know you may not be able to stay for the whole program, just in case that when we get to the slide about finding an authorized person at your current lender to sign off on an insurance check so you can negotiate it. Would the Disaster Response Network be able to help people with that?
Sure, yeah, they will, they are very familiar with the insurance claims process, so they can walk you through the whole process, why your lender is on the check, which I can talk about a little bit, because your mortgage, your property is secured by your mortgage. That's why your lender is on the check, because they have an interest in making sure you repair. So that's one of the reasons, or that is the reason. But they can walk you through, how that whole claims process works and the draws and all that kind of important stuff.
Great. Well, thank you. Okay, so stay with us as long as you can. And thanks again. So we've got folks here on the expert panel that can talk to you about the options for if you do pay off your loan, your existing mortgage, and then you need to borrow money to finish your project. We know that 2/3 of people who lose their homes in wildfires typically are underinsured. And so a lot of folks are in a situation where they don't have enough money to rebuild the house that they had unless they borrow some money. So in terms of questions to ask for people who are trying to decide, what do I do with my existing mortgage? Elizabeth, is that a decision-making process that your credit union can help people with?
Absolutely. I think any lender would be able to help someone with this, and just basically analyzing the situation, what they want to do in the future, how they want to use the funds, and if that is the very best thing for them to do is to pay off the mortgage or, of course, possibly rebuild.
Yeah, and Sean, same question to you for Redwood Credit Union. If somebody comes to you and they're a member, do you offer some kind of, I don't want to call it necessarily credit counseling, but do you offer them decision-making help in terms of what would be the best option for them?
Yes, that was one of our primary objectives in the Tudd fire when we suffered such great losses in our community, was reaching out to people and just asking what their intent was. Do you intend on rebuilding, or are you going to sell? How are you going to go about this? And we left the choice up to the members to decide whether they would like to pay off their mortgage in full and not have that payment anymore, or if they wanted to keep those payments current and have the mortgage on the book remain on the books.
Yeah, and so the two reference guides we have here on the bottom, we've got Underinsurance 101, which is a link to the section of UP's website where we have curated a lot of different resources on remedying underinsurance and navigating that situation. And then we do have the Fannie Mae publication link there, Don't Pay Before You Plan. And I think, everybody on this panel would say the same thing, that don't make any major decisions before you really have thought things through. I would say, in all my years of talking to people like Annie, who've been through a loss, everybody has something that they wish they had done differently. Hindsight 2020, you make the best decisions that you can at the time with the information that you have. But there really are some good resources out there to help you make those decisions. In addition, there are certified financial planners that can help you. But I know that a lot of lenders, particularly, I guess I want to ask, maybe I'll ask, I'm going to ask this one to Elizabeth again. What makes a credit union, are credit unions like softer and kinder and gentler than like a federally chartered bank, would you say?
Yeah, that's a good way to put it. I would say that our sole focus, as Sean sort of pointed out, is really helping that member. That we want to do what's best for that member. So we're going to advise them what's best for them in the future. And yeah, we're probably soft. We're very kind people, I will tell you that. And we care deeply.
Yeah.
Credit unions care deeply about their community and about their members, and they want to find a solution and help with that solution as well.
But of course we know, Sidra, that many of the people that are dialed in tonight may have their mortgage with a Citibank, a Chase Bank, a National Bank. And we hear a lot of people struggling, to track down a human being. So I think the Disaster Response Network hotline could be really helpful there. So as far as covering, knowing what's available to you, so in UP we are our specialty is, helping you really know, figure out how much insurance money you have available to you, and then collecting that money. We have already offered, and it's recorded, you can watch it on our website, a primer on how to read your policy. I would guess by now, people in both California and Colorado from the fires last year are well down the road in having a pretty good idea of how much insurance you have available to you. But it's always a good idea to not just go with what the insurance adjuster tells you, and to really, either watch our video, one of our webinars where we tackle this topic, or read some of our publications, because it's happened many times over the years that people think, they get an adjuster that comes out, and it may be often not a very experienced adjuster, and they may do kind of a superficial read of the policy and say, looks like you've got this much coverage A, this much coverage B, etc. And then they find out that there are some pockets of coverage that they missed, that the adjuster didn't flag for them. And a lot of what we try to do is try to help that not happen. So let me ask Sean a question from the California Bank there, and Todd, I'm not meaning to leave you out, I promise. Do you guys get involved at the bank in helping people look at their insurance documents? I mean, will you look at a member's insurance policy and help them figure out what they've got, or is that out of the scope of what you'll do?
As a financial institution, we do have a division within our services group that can take a look at insurance information and provide that. But on the mortgage side, on the lending side, the interpretation of an insurance policy isn't something that we really get into with members very deeply.
Todd, same question. Is that something that at elevations that you will typically get involved in with a member and taking a look at their home insurance policy after they've had a loss and helping them figure that out?
Yeah, I would say the same as Sean. Typically, we have a group that we would refer them to kind of look at it. And we have pretty good relationships with insurance companies in and around the area that we had reached out during this time just to educate ourselves on. Mm-hmm. So we'll oftentimes refer them to those companies as well, just to kind of get a second opinion.
Yeah, thank you. So before we leave this slide, the bullet point number 2, Sidra, this might be, I don't want to throw you like a really tricky one, but this is something that seems to be very confusing to a lot of people. And that is, if my insurance, let's say my insurance company cuts me a check for my dwelling. Let's say it's a State Farm and they're going to cut me a nice big fat check and they're not going to withhold depreciation. And it's more than my loan balance. Mm-hmm. Then what should the lender do in that situation?
Yeah, so anything that is greater than your loan balance should be released to you, because that your loan is or the claim is only secured by the amount of the loan that you owe. So anything beyond your unpaid principal balance should be released to you, and that sometimes also could apply to your contents coverage. That should also be released to you if it accidentally goes to your lender or your servicer.
So Todd, not wanting to put you on the hot seat, I understand this doesn't always happen, that sometimes a lender will not release funds above the principal loan balance. Is that something that you've encountered?
Yeah, I may defer to Liz to some degree on this, because recently we've had the example you gave is got $1 million payout from their insurance company. Their mortgage was only $600,000, and the servicing company had some limitations on what they would release back to them over and above the mortgage amount. I think there was a kind of a ratio. I don't know, Liz, you would probably know more.
Yeah, Todd, I think I know what you're talking about. They were going to actually rebuild though, correct?
Yes.
Okay, so that changes. Maybe Sidra can talk about that when they're going to rebuild.
So, and even if you're going to rebuild, the amount greater than the unpaid principal balance generally should be released. For the amount the insurance proceeds that are less than or equal to the principal balance should be held in an escrow account, and that's something Amy talked about. Basically, that is in account for your benefit, where the claim that is not drawn yet. So usually how insurance proceeds are distributed is, particularly when you get to a total loss, is a third as various milestones are met. And so those unused portions would be held in escrow. But again, generally, at least if you're following Fannie Mae's policies, the amount that is greater than the amount that you owe it on your mortgage should be released.
Okay.
Good to know.
Sorry, did you have something you want to add on that?
I just say that's good to know, because we
Yeah.
get some contradictory information. So
Yeah,
thank you
that's
for
always
clearing
been, that's been our understanding. So just a review of things to avoid when working with your lender or servicer to release funds. Paying off a low interest rate mortgage without a specific plan, definitely want to avoid that. And I think, most people are probably aware that interest rates are rising now. And so if you have a nice low rate, you might want to hold on to that. Launching any construction project without a game plan, definitely want to avoid that. I think, Sean, why is it a problem to not have your paperwork in order when you're trying to get started with a project?
Well, this goes back to that, what they call the loss draft process, the insurance proceeds that you get for the loss of your property in your home. Because part of the procedures to having funds released to you is to have the insurance adjuster's report, have the contractor's budget and the contracts ready to submit so that you can move forward with that rebuild and make the disbursement of your restricted escrow funds more efficient. So having that documentation as quickly as possible is going to make things a lot easier down the line when you're looking to get that rebuild complete and have those funds dispersed to your contractor based on the project.
Yeah. So Annie, what's the problem with rushing to hire a builder without due diligence? I mean, I know in California, just like in Colorado and pretty much every wildfire area we've ever worked in, I've always encountered somebody who says, I want to be the first, I'm going to rebuild within a year, and I already reserved a builder because I know there's so much competition. So Annie, talk to us about why that's to be avoided, to rushing without researching.
Yeah, so the people who rushed in my neighborhood, a lot of them signed with the wrong builder. And by wrong, I mean maybe somebody who did not finish the build, somebody who wanted more money than what they initially had told them without any change orders, or somebody who did subpar work. All of those things just prolong your agony. It's like re-victimizing you. The bigger the builder you use, the more homes that they've built, the better chance you have of getting a good build. You also will get economy of scale doing it that way. But in the big picture, the things that were really highlighted to us was any builder who came in and said, how much money do you have for your insurance? Oh, I can build for that. That is a huge red flag. Looking at the contractor's license is good. Looking at the California State Licensing Board is good, but those are not foolproof by any means, because there's a lot of things that happen in our neighborhood that there is no marks on those builders' records. So, asking them for 3 or 4 referrals to people that they have already built for and actually having in-depth conversations is huge. Also going with your gut instinct. If something does not feel right, or if it seems too good to be true, it normally is.
Yeah. And we have a new publication on our website on avoiding frauds and scams, and we go into some more kind of details on this, and we'll put a link to that in the chat. And those of you who are dialed in, you can look in the chat for some links. Because we had so many people register tonight, and because we have a nice hearty panel, we didn't we didn't think it would make it would work time-wise to allow questions. So, but we are sharing information in the chat. And if you do have questions after tonight, I'm going to give you a couple of ways to get answers to those questions. So time and materials is one approach to a rebuild as opposed to a fixed price contract. So I would like to ask the Colorado team and then the California guy, if a member comes to you with a time and materials project, is that going to give you heartburn in terms of if they're looking for financing, for gap financing for their insurance shortfall? So you want to start, Todd?
Sure. You know, time and materials is normally what we see as a contract in Colorado right now, especially with rising material and labor costs. What we would typically do is we would look at that budget. We have our own kind of budget template that we look at to make sure all the costs are identified in the budget, because there are some items that the builder may leave out, such as, I don't know, building permits. You may assume that's a responsibility of the homeowner. So as we review the budget, we'll make sure that everything looks to be accounted for. And then likewise, we're also going to look, is that number realistic based on, we do hundreds of projects a year, so we'll kind of do a little bit of cross analysis with other projects of similar size and nature to make sure that the numbers that are provided are realistic. And then the third thing we're going to do is we usually put a pretty strong contingency in there, because there are so many items outside the control of the homeowner and the builder that will add that contingency to absorb any unforeseen cost increases or items like that.
Mm-hmm. Thank you. Sean, same question. If does it give you heartburn to see a time and materials project?
Well, as Todd spoke to, a lot of builders, especially with rising costs, are probably wanting to move away from like fixed price construction contracts. In the lens of a rebuild, if somebody's just finding a contractor to use insurance proceeds to rebuild, that's harder for us to stipulate what kind of contract you sign with your builder. So in that sense, you get the contract with the builder, and then we perform to that contract and kind of try to help manage the rebuild accordingly. And if there are shortfalls between the insurance proceeds and the eventual total cost to rebuild, then we need to cross those bridges when we get there and figure out ways to cover that shortfall. But definitely on the construction loan side, if we've gone that route with people, we have been requiring fixed price contracts simply because at the end of the loan process, we want to know how much is this home supposed to cost, and is our loan amount and your own personal funds going to be enough to satisfy that contract? And if it's a time and materials thing where that contract price could increase, then we don't have that level of certainty that the amount of money we've got dedicated to the project right now is going to be enough to carry it to completion. Yep.
So the more detail, the better. And of course, the more reliable, the better. So tracking down an authorized signer, we're kind of jumping back to this this question that we talked about a little earlier, and this is really more if you have somebody who's got a loan and an outstanding mortgage with a not a credit union, but like a national bank. I think, Sidra, if you're still with us, this is just something that we offer people as on our website as a way to give them a clue to how do you find a person, and I mean, maybe even go back a step. How does somebody, even if they're not even sure who holds their mortgage, how do people figure that out? And then second question is how do they figure out how to find somebody there that's going to help them?
Sure. So usually the easiest way to identify who is the servicer of your loan is who are you getting your monthly mortgage statement from? And so that's the easiest way to identify.
Okay.
If you want to find out who is the investor, who your mortgage may have been sold to, if you go to the knowyouroptions.com site that Amy, you had up before, we actually have a loan lookup tool, and you can find out whether or not Fannie Mae owns your mortgage, and Freddie Mac has a similar tool on their site. In terms of like, if you have like, a mortgage with like one of the large guys, generally there's somebody in one of the branch banks who can sign those insurance checks. And so that's where I would start if you, can't get a hold of somebody, on the phone or through other means. So that's where I would generally start.
Great, thank you. Okay, so I'm going to ask this question to the Colorado and the California folks in order. I guess I'll bounce back to Colorado. What are the construction loan options that your entity offers? Todd, if you want to start.
Sure. So there's two loan products that we're currently offering on construction loans. The first is your traditional construction loan. It's an interest-only loan based on the proceeds as you borrow it. And the way the construction loan works is as part of the process, you give a set of plans, cost breakdown. We give it to an appraiser. Appraiser goes out and says, if this home were built today, it'd be worth X, and we loan a percentage of X. Because of the Marshall Fire victim situation, we've increased our advance rate to 90% of the appraised value, just because we've recognized that a lot of those people are underinsured. The other option is, as you said below, the single close construction financing. That's probably more the choice most people are moving towards with the rising interest rate. That allows you to do a construction loan, but at the time you're originating the construction loan, you're also locking in the mortgage rate going forward. And in today's market, as you said, the rates are rising. People are taking advantage of that product the most, it seems like.
Okay.
And it kind of depends on if there's an event down the road. Some people are doing a construction loan. When they get their second disbursement from the insurance company, they're looking at the construction loan to bridge the gap until they get the proceeds from the insurance company. So they may keep their mortgage in place, get a construction loan, bridge the gap, get the house done. They get their remaining proceeds and maybe some of their own cash, and then pay off the construction loan in its entirety. So those people are usually opting for the former of the two products.
Okay, thank you. Sean, same question.
So the construction loan options we have are going to be slightly different. We do offer the single close construction financing, so it provides the construction monies to build the home, as well as the securing of a permanent mortgage after that into the same transaction. So we don't have the same kind of get this construction loan to cover your insurance shortfall and then roll it into a refinance and make it all into one payment. But the construction loan would essentially be a refinance of whatever mortgage or liens on the property, and we would start from the scratch and have that construction loan pay for the rebuild of the home and then transition to the permanent mortgage financing after that.
Okay. And what does that have a name? That product?
A construction loan.
Okay.
Yeah, single close construction loan. So they're very similar to traditional mortgage products, 30-year fixed, 15-year fixed, or different ARM products that may be available. But the difference is they come with the construction piece at the front of it where you have the funds utilized to build the home.
I gotcha. Okay. All right. So yeah, you want to talk to your lender and see if they will offer these type of options, a gap or a bridge loan, a short-term residential loan to meet your immediate financial obligation, which then gets rolled into a longer-term tool. What about a home equity line of credit? Can one of the panelists explain what that is?
Yeah. So specifically to address the underinsured in our communities, the gap financing options were brought up and created as it was definitely not a standard product, but we were finding a lot of people getting into their rebuilds and running out of insurance money. And maybe they're 50, 75, 80% done with their build, but they're out of money and they cannot continue. So based on a HELOC, we created a gap product so that people could access that last, $250,000 they need to get their home finished. And it was essentially a HELOC on their property, whether it's behind the first mortgage that's already there or it's the only financing. that's on the property itself, but it was that tool for them to be able to get the funds to complete the build. Because when you've got a project that's in the middle of the process, you're not going to find a lender who's willing to do a construction loan to get you the funds to finish the project that's already begun.
Right. Okay, so we talked about the conversion of a construction loan to a permanent mortgage, fixed rate mortgage. We talked a little bit about a construction only loan. What about owner builder? You know, a lot of people get pretty creative when they're underinsured. I've known quite a few people that have said, heck, I'll be my own GC and I'm going to do this. You know, as a lender, like, how do you feel about that? Todd, you want to start?
Yeah, and we've seen a lot of people wanting to do that. And for us, they have to be a licensed general contractor, and particularly in today's market, because the homeowner doesn't have the resources that a licensed general contractor has as far as subcontractors, plumbers, electricians, framers, all that stuff, because here in Colorado, the market's pretty tight. So we try to discourage that. And if the homeowner wants to do some of the services along the way as they go, like, paint the walls or do some other things, that's fine. But to be the general contractor over the whole project is a pretty large undertaking, especially as tight as the market is for labor and resources.
Yep.
We discourage it.
You discourage it, yeah. Sean, anything different to add, or you're pretty much in sync?
They would pretty much be in sync with that. If somebody wants to do an owner builder, they themselves would have to be a licensed general contractor with the comparable experience, simply because we're already financing something that doesn't exist right now, and
Right.
that risk on top of maybe the project doesn't get finished, that's a really tough spot to be in. So we want to make sure whoever's managing the project is going to be able to finish it within budget and on time. And those are really complex factors when you're dealing with an entire home being built. And your average homeowner, while they think, they might be able to handle it, or, they've got some buddies and friends that can help guide them along the way, it doesn't always work out that well. And in general, I've heard that, even subcontractors, if they've got a homeowner who's acting as owner builder and they're reaching out and trying to schedule subcontractors, those subs will charge more for somebody who's not a licensed GC and doesn't do it as their own job, because they know that there are risks to them in accepting this job from somebody who isn't, in the trade, in the field. So it can actually end up costing some more if you're paying the subs more, because they're a little wary of taking on your project because you're not a general contractor yourself.
That's very, very important information. Thank you. Okay, paying for construction with insurance funds. United Policyholders really emphasizes over and over how important it is to try to reach an agreement with your insurance company as soon as you can over the cost of putting back the home that you lost as it was. And we certainly recognize that almost nobody wants to build the identical home. Almost everybody wants to go big or small or different. But what the insurer owes you is what it would cost in theory, hypothetically, to put back the exact same house. And a lot of people, and with the help of the adjusters that the insurance companies send out, sometimes try to skip that step and kind of just jump to what they want to do. And then they'll just go on what the adjuster's estimate was. And sometimes the adjuster's estimate was not, was a exactimate, computer estimate, and maybe really needed some tweaking to bring it to real life pricing, but they sort of skip that over and they start, moving ahead. So we really encourage you out there to understand why we recommend trying to reach that agreement before you embark on a project. And even if it means you have to pay a little bit of money, to get an estimator to help you with get an accurate as was. It's time well spent. So escrow accounts and fund control required if you have a mortgage. Annie, why? So in your case, Annie, you had you got a nice big fat check from your insurer, and so you wouldn't have had to go through a mortgage escrow account. So how did you deal with paying for your rebuild from insurance funds?
Well, I made the first mistake, which is I paid off my mortgage. I had no clue that I should not. I thought that would be a clearer path for me. My insurance is actually fairly easy to navigate, and I picked a bigger builder, so they he required an escrow account. I had very little knowledge of any of this, and we didn't realize until we really got into the weeds how important it was. The escrow account was protection for me, also for the builder, but for me in the sense that my builder was never going to get ahead of a milestone. So if I was at 50% of my build, he was going to have 50% of the money. Many people in our neighborhood had smaller builders. They couldn't finance it. And all of a sudden they'd be at a 50% build with 85% of the funds. So we kind of learned that lesson the hard way about the escrow accounts and the protection that it does supply you, and the protection it does supply to a smaller builder also.
So you can open an escrow account even if you don't have a loan, right? So it's basically a kind of a bank account. But for Todd and Sean, for any of your borrowers that are undertaking a rebuild, they're going to have an escrow account tied to their loan, right?
Yes. And we would look at it, you're using the term escrow, we call it like a controlled disbursement account to do exactly what Annie specified to make sure that there's checks and balances and the builder doesn't get more funds and work completed.
Mm-hmm. Sean, anything to add there?
No, it's we would call it a restricted escrow account. It would be tied to the same servicer that sends your mortgage statements and everything, but it would be the same thing, a funds control account that gets drawn from as the project progresses.
Okay, so how much involvement do you have, Sean, over the life of a construction project with the owner's insurance company in a situation with a rebuild? Like, is it a regular communication? You establish a trust relationship so the insurance company knows if Sean or somebody from the bank calls and says, okay, we've inspected their 50% or they've completed more, it's time to release some more funds. Is that kind of how it works?
Usually what will happen is the insurance company will continue sending checks to the homeowner based on their insurance claim and whatever coverages they've got and what they've negotiated as a settlement. So the homeowner brings those to us to further deposit to their restricted escrow account. And then we work primarily with the servicer to get reimbursed from that restricted escrow account as we issue draws to the contractor completing the project. So usually the insurance company is kind of outside of that process.
Okay.
But there are times where the insurance company gets to a certain point, like you said, they may withhold depreciation. But they get to that point where they're not dispersing any more funds until they get invoices and see inspections and know that these monies have been paid towards the rebuild of this house. It's this percent complete. And once they can certify that, then they'll issue additional funds for us to utilize to pay the contractor with.
Right. So generally the insurance company needs proof that the monies have been spent. It's just like with your contents inventory where you know, if they've withheld depreciation and you want to collect your replacement, the balance of what they owe you, you've got to give them some sort of proof that you bought and replaced these items, and then more money will flow. Todd, it's the same. Is the same for you? Anything to add on the process of getting an insurer to issue additional payments on a project? Do you have a connection with the insurers where you're talking to them and assuring them that somebody from the bank has inspected and the work is proceeding, or is that beyond the scope of your involvement.
No, we do the same thing. And part of the process of a construction loan, as you point out here, is a lot of the stuff we supply to the insurance company just to validate that the work's been completed. So with the homeowner's approval, we'll disclose everything through the draw process. Here's the invoice, here's our inspector's report, here's the lien waivers, here's all this. And most insurance companies have been pretty comfortable with that documentation to release the funds as they go.
Yeah, and I checked in with a couple of insurance folks and some public adjusters before today, just to kind of get a feel for for how people see this working in real life. And it sounds like it's just like everything else with insurance claims that we know, which is it really depends on your insurance company. And what level of proof they require of progress that's been made on the project. And, and some of them will require a lot of proof, and some of them will go on a phone call. Annie, you taught me a lot about the value of an escrow account, but more importantly, the value of having somebody other than the homeowner evaluate the construction progress and whether the builder is on track or getting ahead. Do you want to speak to that?
Yeah, I think the biggest thing that I learned in this process, and we had lost 1,400 homes in Coffee Park, and so we had a lot of evidence of what could go wrong, how it could go wrong, and the escrow account was a lifesaver for many, but even before that, having an attorney review your contract to make sure that it's not just written in favor of the builder is huge. And then having a private inspector, because the city and the county do a very low grade inspection, not for a lot of quality. And if they miss something, they're not liable. And so it's a little bit for our community, it was a bit of a flawed situation. So having those things in place where you've had your contract reviewed, you have an escrow account, you have a private inspection company, it is definitely advantageous to you as a homeowner. I mean, usually it's your biggest investment in life, and you're just paying a couple extra $1,000 to secure that.
Mm-hmm. Yeah. Okay. So we're rounding the corner here. We already covered. We talked about a HELOC, but just to review the three options for paying for your rebuild. So either your insurance company and a lender coordinate and manage payments to the builder if you have a mortgage or a loan. If you don't, as in Annie's case where she paid off her mortgage, you hire a builder and you pay from insurance proceeds, but then best practices to set up an escrow account and have an inspector associated with the lender to help you with that. And then the third is to obtain a construction loan or HELOC, home equity line of credit. Where can additional funds come from if you're underinsured? External savings, using some of your personal property, using some of your retirement savings, incorporating an ADU or granny unit within the rebuild so that you'll have some rental income coming your way. Just a few more slides on construction quality control. Be mindful of change orders and how they're going to impact the final bill. Be aware of the terms of you heard Annie suggest having a lawyer review your contract with a builder before you sign it. Todd, I mean, does it seem to you that the competition for builders is just fierce and scary for people in your area?
Yes, I mean, most of the builders in this market were pretty busy anyway, just because of demand. So they're pretty busy. I know a lot of builders, because it impacted all of us, have elected that they're going to do as many homes as, some have come out committed to, hey, I'm going to do 10 homes in this market, even though we're very busy. But it also goes across all fronts. It's architects, engineers, the municipalities themselves are busy because nobody this many homes at one time to go on the
Right.
market needing construction or some kind of work done is a lot for this community, for this market. So
Yeah. Sean, what have you observed in terms of, I know after the 2017 fires, I spent a lot of time in your area. There were a lot of builders who were commercial builders who really didn't do residential, and they were kind of thinking about getting into the residential just to help out. What does the picture look like at this stage in terms of availability of builders?
I don't necessarily think we have as quite a big of an impact as we did back then with just the demand for them, with so many homes needing to be rebuilt. But builders still have a very long lead time, especially the good ones who are, their projects are booked out for, the next 6 months to a year in advance. So, there's definitely an impact not only on rebuilds, but people looking to do their typical construction projects, large renovations and ADU builds and things like that.
Mm-hmm. How involved do you guys get in looking at a borrower's contract? I mean, will you look at it, or do you just look at the budget?
we look at the contract to make sure everything's accounted for, so there's no surprises at the end of the project and stuff. And we look at a lot of contracts, so if we see something missing, we'll alert the borrower to it, just to make sure all items are addressed and everybody's on the same page. So we look at it quite a bit.
Yeah, and just so that the audience knows, coming up, we haven't actually advertised it or firmed up the dates, but we are going to be doing an additional workshop on best practices with the construction project, and that will be coming up. So this is just a good link to, well, this for California residents, a resource on helping you with review a builder contract. We talked about a private inspector. Very important to get a lien release when construction is finished, but we're going to be covering these things in a lot more detail in the next webinar in this series. Here is the reference for the California Department of Insurance. If you have any problems with your insurance and need help from them, here's the Colorado Division of Insurance and their website. On our website, the uphelp.org website, you can go to the state by state help directory, and you'll find the link to the Contractor State Licensing Board in Colorado, as well as California. So because we didn't give folks an opportunity to ask questions tonight, you are welcome to put questions in either to info@uphelp.org or try out our new, it's not really new, but we rebuilt it, our Ask an Expert forum. It's something that we had made available many years ago. People were using it, but it was a little clunky. And so we redesigned it, and we relaunched it. And you can put questions in there and just be patient with us. Even though we look big, we're small but mighty, we say. And we do our best to answer every question that comes our way. Sean, Sidra, Todd, Elizabeth, in closing, I just want to ask each of you before we log off, when a person comes to you at work or at a store in the neighborhood, and tells you that they've lost their home, in a wildfire, is there one piece of advice that you offer them based on the experience you have in the banking sector? I'm going to start with you, Sidra.
Yeah, I think it goes back to having a plan. Don't make any rash decisions. reach out to your servicer or your lender and let them know what has happened. They're an asset for you. Don't be afraid, and really, take a forbearance and figure out what you want to do if you want to rebuild. And if you do want to rebuild, I would say do not pay off your loan.
Elizabeth?
Yeah, I would agree with Sidra. I think really analyzing your situation, not making any rash decisions. You have a community around you who can help you, a lot of resources. I think people have a hard time finding resources. So thank you for all that you do, Amy and Annie and Valerie as well, for the communities. And so I think just really being thoughtful about it, not rushing into anything, taking some time away from it also helps people, maybe doing something different than worrying about it all the time.
Yeah, very good. Sean, any thoughts there?
I would just echo, have a plan. And I know it's hard because you feel like you've got to rebuild. You've got to get this started now and get it done. But take the time to really think about what you really want to do and how to make that happen. Take the time to make sure that you've got the right people in your corner who are working on your behalf and helping you get through this process confidently and competently. And it's going to be a process. It's going to take a long time, but if you allow yourself that time, you can make sure you do it right and you'll come out of it okay.
Thank you. Annie, closing thoughts?
I think that the biggest thing I can say is and it's the hardest thing to navigate as a survivor, is to be patient. Everything triggers you to have anxiety. You find out that somebody's signed a contract or there's a foundation going in, and that immediately just clamps onto you. And you think, oh my gosh, there's a foundation. And then you think, but it's not mine. I'm not in a contract. And the bottom line is, you need to do your due diligence. This is your biggest investment in life, and you do not want the headache of it being prolonged for multiple years because you didn't pick the right builder or you didn't have the right information. So that would be mine.
Well, this has been a really, really great panel. I so appreciate everyone's time, expertise, and wisdom. And I want to thank everyone. I want to thank our panel. I want to thank my staff for participating. Those of you who dialed in, we will be making this recording available, so you don't need to worry if you've missed something and want to hear it again. And then we will be advertising as soon as we get the date set for the next series on best practices for rebuilding. So with that, I want to say have a safe, healthy evening. Hope you all get a good night's sleep. And from United Policyholders, thank you for bringing your attention and time to us this evening, and good night.
Thank you.
Thank you.
Thank all of you guys. We appreciate you.